Whether you just started investing or are getting close to retirement, the basic principles of using index funds to optimally allocate a portfolio are crucial to understand. The reason is that index funds are super easy to buy, they make diversifying a portfolio easy to do, they're typically very cheap to own, and with the right ones, they've historically done very well over time. Because of that, I'm about to cover topics like what matters most when investing, how asset allocation works, what's typically recommended by age, and key factors that affect your risk tolerance. But before we get started, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over what matters most when investing. According to the Bureau of Economic Analysis, the average personal savings rate for someone in the US as a whole comes out to be around the 5% mark. Because of this, please be aware that of all the factors to consider for a successful retirement, your rate of savings is the most important one in determining how long it'll actually take you to reach your financial goals. In fact, further data on this topic showed how 3 people who started to save at the exact same time, they each earned $100,000 in income, growing at 3% each year, and the study assumes their investments average 7% per year for 30 years. The biggest thing to take away from this is the difference in how much someone saves. So if that is 5% or 10%, that could make the difference of ending with roughly $650,000 or $1.3 million for your future. All in all, before we talk about index funds, just realize how important it is to save each month, because without it, how can you even invest? Which I will say, if you are interested to get started with a new investing platform or high yield savings account, I'll have a direct link below to some of the top options currently available in the market. Now, before I show these specific allocations for each age group, let's now go over a quick overview of asset allocation. Now, asset allocation is simply how you divide your investment portfolio among different types of investments, primarily stocks, bonds, or cash. And so the model that I believe is best when it comes to investing is that you ideally want to maximize your potential returns while minimizing the downside risk of losing money. So if you only pick a few individual stocks to invest all of your retirement savings, you may earn extremely high returns, but you may also have very high risk that could cost you your retirement. In fact, over a 20-year investing period, only 21% of companies survive and outperform the market, where 52% of them are delisted. Where on the other hand, if you are investing with too low of risk, like putting it all into treasury bills or CDs, that would be much safer to get low returns, but the con here is that you may not have enough at retirement to last the rest of your life. That right there is exactly why asset allocation is so important, because the types of assets that you own can make or break your future. And so 2 of the main purposes behind asset allocation is to understand the risk you are taking between growth investments like stocks to build up your portfolio to more stable investments like bonds in order to preserve safety as you approach retirement. This is exactly where index funds make everything so much easier, because instead of trying to pick individual stocks and bonds, you can get instant diversification into broad areas of the markets that you choose, all within one simple purchase. Knowing that, let's now go over the specific allocations to consider based on your age and general guidelines, starting with your 20s and 30s being the growth mode. Now, a good chunk of the data I'm about to provide is from Vanguard, who gave transparency on a typical target date fund glide path, which pretty much shows how they typically recommend different exposure and allocations based on the phase of your life that you are in. So to simply start this off, notice how if you're in your 20s and 30s, you are in the early phase of your career, and the general baseline here is 90% stocks and 10% bonds. This actually aligns with Warren Buffett's recommendation of having 90% in an S&P 500 index fund and 10% in bonds, which this simple approach is actually the one that he's recommending for his own wife's inheritance. But to add even more detail into this, a general rule of thumb that I like to refer to is the 110 rule, which simply means you take 110 and subtract it by your age. So let's say you're 30. Whatever number you get, for this case that would be 80, then that amount would be how much you have in stocks when compared to bonds. Now realize this depends entirely on your situation, and near the end of the video I'll cover key factors of what to be aware of when you are customizing your own risk tolerance, but please understand that this is not financial advice and you must do your own research. But the reason for a glide path like this and having higher stock allocations when you're young is because during your young years, time is your greatest asset, and having 30 to 40 years until you retire you can weather through market volatility and greatly benefit from compounding the growth on your investments over that time. And not to mention, but the S&P 500 since 1957 has delivered an average annual return of just over 10% per year. To see the difference, if you invest $500 monthly in index funds, earning the market's average of 10% per year, that would grow close to $3 million over 40 years. But if you were to wait just 10 years to get started, that number drops down to $1 million. So a few final tips for those in the 20s and 30s is to remember to take full advantage of things like employer contribution matches, and make sure that you're prioritizing tax-advantaged accounts like your 401k, Roth IRA, or HSA to reap even better tax benefits. And by the way, if you want to see this in more detail, we have an article posted on InvestLane that I'll have linked in the description below. But knowing that, let's now discuss your 40s and how you may want to start to balance. When in the 40s, you are considered mid-career in the early transition phase for planning your retirement, where Vanguard even says it's okay to start with 90% stocks, 10% bonds, but now to gradually reduce the stock exposure to build a more conservative portfolio over time. As you can see from the glide path image, it shows certain areas should change in exposure over time, but personally, I think they recommend too much international exposure. But the reason that starting to balance your assets is crucial to understand early is because the markets are extremely volatile and no one knows what could happen. In this visual, you can see how the markets change over time and that there have been many bull markets where you would have grown your investments very well in a fairly short period of time, but there have also been bear markets where the markets declined or barely returned any gains over many years. And not to mention, but for the S&P 500, the rolling returns, which means these are the returns based on the period of time you held below. If we first only look at the blue chart for 3-year periods, the volatility is much higher, and if you're relying on your money to grow in 3 years, the odds are not very safe, since there are many times you would have lost money. But if you extend your time horizon to 10 years, notice that there have been times in history where you would have still lost or barely seen any gains, but it's still not as common and the volatility is greatly reduced. And as you increase the time to 20 years, there are no times in history where you would have lost money, so the risk is even lower and the overall volatility is greatly reduced as well. Which, if you stayed invested over 30-year rolling periods, the outcomes are extremely strong and the averages are very consistent across the board, regardless of any market crashes, recessions, or depressions. The market long-term has averaged great outcomes for investors. So a few final tips to note here would be to stay invested long-term, because the data shows if you have 10 to 20 years and above, the stock market has typically averaged very well returns. And since you may have more responsibilities like a mortgage or kids, remember to stay focused on consistency. It may seem easy to stop saving and investing for a few months, but that could also easily lead you into many years, and before you know it, you may have a lot less than you initially anticipated by the time that you retire. Aside from that, consider managing your risk with gradual adjustments and even into different investments that may be away from your large cap stock exposure, or even to consider savings products to build a safety net slowly as you near your retirement. Knowing that, let's now discuss the 50s that represent what we like to call the prep mode. Now, your 50s are really important because protecting what you've been building up becomes just as important as growing it. And because you'll likely have 10 to 15 years until retirement, you need to start balancing things between growth and increased stability to preserve your wealth. This is also when transitioning into investments like dividend-focused index funds could become valuable depending on what you're looking for. Now, a motto I love when it comes to investing for retirement is to invest for growth while you're young, to then slowly transition into these strong dividend investments, especially for those that are using an account like the Roth IRA, where you don't plan to touch the funds for a while you're young and investing, and then by retirement, any income that you take out that is produced is completely tax-free. But even with normal taxable accounts, depending on your income threshold and the state, you could even end up paying zero taxes on the qualified dividends. Which, something else to point out is that for those in the 50s, you can also make catch-up contributions to accounts like 401ks and IRAs beyond the standard limits. And a few data points to mention here is that from 1926 to 2023, from 94 5-year rolling periods, the highest likeliness of returns ended up being 29 times that investors would have gained 15 to 20% in annual returns. Then 10 to 15% is the second highest, to then 5 to 10, 0 to 5, and only 6 times it came out lower than 0%. All in all, just realize that your investments could still grow very well, but there could always be a downfall, and at this point, it's highly encouraged to start prepping for a safe retirement rather than taking on more risk that could end up costing you many more years of having to work. So knowing that about your 50s, let's now discuss your 60s and beyond for income and preservation. Now, as you get into your 60s, Vanguard shows to start with 60% stocks, 40% bonds, and to continue allocating more toward the bonds, such as Treasury inflation protected securities known as TIPS. They then quickly show that by age 65 to adjust that to 50 stocks, 50 bonds, and then by 72, they even state to have 30% stocks, 70% bonds. Now, one reason the safety aspect is crucial to understand is because you never know what can happen in the market, and if you were to retire during a market downturn, retirement could treat you much harder. Especially if you are one taking out money as soon as you retire, this could cause significant pain, and if you look at the difference in this image, the left shows a bull market for the first 5 years after retirement, then a bear market the following 5 years. Where the right side shows a bear market for the first 5 years and a bull market the following years, and now if you take out the same amount each year for each scenario, with the first 5 years being a good market, you could still have, after 10 years, almost the exact same amount, even after pulling money out. But if the first 5 years are bad, then you could drop from $100,000 down to $63,000, which is a huge difference. Now, of course, these are general guidelines to know about, but let me explain the factors toward customizing based on your own risk tolerance. Because everyone's situation is different, realize that these guidelines are not meant to perfectly fit your position. There are numerous factors that can influence how you adjust your portfolio, such as your personal risk tolerance and how comfortable you are with market ups and downs, your ability to save, how much you've saved already, your time horizon and certain financial goals, the accounts you use and their tax structures, potential life events or responsibilities that you have, certain debts if you have any, or behavioral tendencies. All of these factors and many more contribute to the decisions you make with your investments. The key here with all this is to become aware of the information that could help you make a better decision for yourself, because in the end, you are the CEO of your own life and you know your personal situation the best. Now, if you want to see some of our top index funds, I'll have an entire index fund cheat sheet that I created linked in the description below. And while you're at it, if you want to start investing on a new platform or have your savings earn more interest with a high yield savings account or CDs, I'll have direct links to some of the top options available in the market. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice and you must do your own research. And as always, if you found value in this video, don't forget to hit the like, subscribe, and notifications button for future content like this.